This is the Norris Group's Real Estate Investor Radio Show, the award-winning show dedicated to thought leaders shaping the real estate industry and local experts revealing their insider tips to succeed in an ever-changing real estate market. Hosted by author, investor, and hard money lender, Bruce Norris.
On Friday, October 21st, the Norris Group proudly presented its 9th annual award-winning black tie event, I Survived Real Estate. An incredible lineup of industry experts joined Bruce Norris to discuss perplexing industry trends, head-scratching legislation, and opportunities emerging for real estate professionals. Proceeds from the event benefited Make-A-Wish and St. Jude Children's Research Hospital. This event would not have been possible without the generous help of the following platinum partners: Housing Wire, PropertyRadar, the Apartment Owners Association, the San Diego Creative Real Estate Investors Association, Invest Club for Women, MVT Productions, the San Jose Real Estate Investors Association, Inland Empire Real Estate Investment Club, Think Realty, and White House Catering. Visit isurvivedrealestate.com for event information and tickets.
Maybe we should first say that you've divided what we think of generations often into much smaller, decade-long. So millennials were generally divided into two new names.
Right.
So what were those names?
We broke them out into those born in the 1980s, and we call them the sharers because they really invented the sharing economy. And then those born in the 1990s, and we call them the connectors because they're the ones leading us being connected 24/7 with our smartphones. And I was, with all this millennial analysis, first, everybody's definition of when it starts and when it ends is different. Mark Zuckerberg is a millennial, and so is my daughter, who's a high school junior. I think they're in different stages of their life. Right. But everybody can relate to what year you're born and your high school classmates. So that's we broke it down by decade, and then you can compare 10-year periods to each other. Everybody says, "Yeah, I was born in the '60s." It's just easier. One of
the things why I brought that up is that one thing that it seems like they have in common, they're underemployed.
Yes.
So what do you mean when you say underemployed? That they have like a master's degree and they can't get a job for that? Or they have a skill set there's not a job for?
They have a skill set that there's not a job for. That's actually a government statistic. I think the BLS puts it out.
Okay.
For people in their 20s, what percent are underemployed? And usually a lot of people are underemployed in their 20% in their 20s. The normal percentage is around 25%, but it's been running about 42%.
So they have the capacity to earn a lot more money if they could only find a job that fit their skill set?
I've got a college degree and I'm working in retail.
Okay. Is that going to change?
I think it's going to change dramatically.
Okay, well, that's good.
So here's one of the big demographic shifts that's going on, and it just started a few years ago. So remember the baby boom started in 46, 47?
Right.
So those people all started turning 65 a few years ago. And we have seen the number of people retiring go from 2.5 million to 3.5 million per year in a very short time period. Long story short, the population aged 20 to 64 is only growing by 1 million per year right now, and it's used to growing 2, and it's going to 500,000 per year. Just do the math. And so that's going to create a lot of tightness in the labor supply. Now the question is, can enough automation come along to solve the problem? And so that's the question. But I think the surge in retirement that we're seeing today is going to provide a lot more employment opportunity for young people.
Okay.
And one technical note on that, I think this year is the year that the oldest boomer turns 70, which is the financial advice is if you're delaying Social Security, start taking it at 70. So that's this year. So I think you'll see an acceleration in the retirement numbers.
Okay. Probably the last question we have time for you guys, and then we'll bring up the other three, and we'll come all back together after the break. Doug, there's... I like charts, so I'm used to looking at historical charts.
That's why I like you.
So we've got 5% unemployment rate, and we have maybe 1+ GDP growth, and a 10-year T-bill that's 1.7. Those three charts have never existed before together. So why is 5% literally full employment not doing what it normally does? What's missing in that employment number?
That's a great question, to which there's lots of controversy among economists. For one thing, we have 95 million people who are working age eligible that are not in the workforce.
What are they doing?
That's a great question. So,
Okay.
so
No, maybe they're getting a PhD and they'll be like awesome later. I don't know.
we have plenty of economists.
Okay.
If you lay all the economists in the world end to end, they won't reach a conclusion. That's all. So a part of it is simply that even the 5% unemployment looks like there should be serious wage inflation. We're not seeing that.
Right.
Well, there's two things there. One is there's all these people still on the sidelines. So when job prospects improve, you start to see some movement back into the labor force, which that increase in supply keeps wages suppressed. So that's in the most recent month's release, you saw about 500,000 people re-entered the labor force because the unemployment rate had gotten that low. The real wage rates accelerated a little bit, but they're still below, today in the seventh year of this expansion, they're still below the average wage rate increase from 2000 out to World War II out to 2000. That's how weak this expansion has been. Going back to what John was talking about, it's economics that's actually holding the younger households back. In terms of the other impact on wage rates not growing, that comes from the lack of productivity. In fact, productivity is historically low, in fact, negative in a recent period. And so the chain of events is businesses expect growth in sales and demand, so they invest in plant and equipment to improve the tools with which their workers work, making them more productive. Sales go up, they can pay those workers more.
Right.
That drawdown and negative productivity thing is, to me, a key factor in this. And in fact, if I was going to point at two things that really trouble me, one is the 30-year decline in new business formation, which suggests that the entrepreneurial spirit in the country is somehow ebbing.
Right.
I find that very worrisome because it's small new businesses that discipline large corporations in the marketplace, force them to compete as opposed to collude. And the second thing is that decline in labor force participation is much more prevalent in working age men than it is in women. Their workforce participation has actually been declining for almost 30 years. It was disguised by the fact that women's participation increased up until 2000 when it peaked and then it started to decline. Those are, to me, the two most troubling statistics looking at why the economy is not doing better.
And you have a theory about why that's changed in 2000, or a little after that.
Well, we did a ton of charts, and you would be stunned how many trends reversed course right around 9/11. The percentage of women staying at home increased. The percentage of men staying at home increased. The emphasis on getting ahead and having dual income households and having a bigger house just shifted. And you can. There's a ton of charts that I went back to and I'm like, holy mackerel. I remember talking about that in 2011, 2001, 2002. People were talking about comfort food and I've changed things. It really changed.
Okay.
And I can't say for sure it was 9/11, but the charts all show it was 2001 is when it shifted.
Okay. Well, thank you both for coming up here and join us in a little bit. We're going to invite our other three guest panelists up. I'll quickly introduce them. Nick Bailey. Nick Bailey serves as Vice President for Zillow Group, helping build the company's strategic partners and relationships throughout the U.S. Bailey helps drive the expansion of products and services through partnerships and the broadening of brand awareness across the real estate industry. He has over 20 years of real estate industry experience as a leader in franchising, brokerage, management, technology, and as a licensed broker. Prior to joining Zillow Group, Bailey spent nearly 12 years at RE/MAX World Headquarters. Gary Acosta also joins us. Gary is one of the co-founders and CEO of the National Association of Hispanic Real Estate Professionals and a 25-year veteran of the housing industry. NAHREP is the nation's largest minority real estate trade organization with over 20,000 members and 40 local chapters. Mr. Acosta has also founded or co-founded several mortgage, real estate, and technology companies, including New Vista Asset Management, Counselor Max, and realestateespanol.com. In 2013, he co-founded the Mortgage Collaborative, a cooperative of mortgage companies who work together to increase profitability and market share. And last but not least, Sean O'Toole. Prior to launching PropertyRadar, Sean O'Toole successfully purchased and flipped more than 150 residential commercial foreclosures. Leveraging 15 years in the software industry, Sean used technology as a key competitive advantage to build a successful real estate investment track record. Sean has always thrived in startup environments and as such became a key contributor at Xing Technology, acquired by Real Networks, ISI Global Center, acquired by Global Crossing, and Icarion Inc., acquired by Workstream Inc. So if I could get you three gentlemen to come on up, we will have everybody back up after the break, so we will be able to have a lot more interplay with these guys as well as the first two guys. And by the way, they're all guys this time, which is...
It's not as fun. No.
Well, actually, no, it's sometimes when you have all guys, it gets out of control, but it seems like a good group. So, Sean, I want to start with you. You had, I think I first met you Foreclosure Radar, and, buying at Trustee Sales, that was really a revolutionary product that really affected people that were in the business, either the people that were providing information. You were able to do it for... Instead of thousands of dollars a year, you were producing it at what, $40 a month or something?
Yeah, 49.
Yeah,
Still 49.
$49, and then when you're a trustee sale buyer, you used to be surrounded by 5 people, and now you're surrounded by 100 people. So it was a game changer. It really was. That's the nature of technology. It seems is that it gets cheaper and it gets a lot more participants. So now you're doing PropertyRadar. So let's talk a little bit about how your client base has expanded, and what services you're providing for those people.
Well, thanks. It certainly has been a shift from 2010, where, like you said, there were so many people buying foreclosures, and a lot of people have had to exit that business. It's still almost 10 times as more foreclosures a month right now as when I was buying foreclosures.
10 times?
Yeah, around 2,000 a month, plus or minus, and about half of those going to third parties. When I was buying, it was about 200 a month, and a greater percentage in the state of California, and a greater percentage going back to the bank. So it really has changed a lot, but there's still a lot of people in that business, and we saw that coming in 2010, so we started to shift into to property, broader property information. Of course, the biggest challenge there is people say, what do you do? We have property info. Oh, do you compete with Zillow? I'm like, no, we don't compete with Zillow. What do you do?
Now we're going to get going.
So that was actually a tough transition for us. But what we found out is that public records is a pretty brilliant thing. As I tell our realtor customers, there's no excuse for not knowing every potential customer by name, right? And how much equity they have, who their lenders are, et cetera, right? That's the power of public records data. And it's what a lot of investor clients here use to find folks to reach out to, see if they're interested in selling their homes. A lot of realtors use to know every client by name. And then we've been expanding a lot into the home services professionals that also, the pest control guy, he can draw a circle around where he's doing business and know every person, every potential customer by name and something about them, whether they own the house or don't own the house, et cetera. So,
okay.
Yeah, it's been great.
Nick, welcome to the panel. First time?
Thank you.
And
First time here.
First time
Appreciate
here. So Zillow started in 2006.
Correct.
That's a lot of movement in 10 years.
It is. One of our culture pieces is move fast, think big. And no doubt it's come true.
The originators of Zillow started other company, and that was in the travel industry, correct?
It was. Rich and Lloyd started Expedia.
Okay.
And Spencer Raskoff, our CEO, was from Hotwire.
Okay.
Expedia acquired them, and
So Expedia, if you're a travel agent, that was really a game changer, right? And is there a lingering feeling that, okay, Zillow's in this space, and that's we're going to become the formerly employed travel agent, only we're going to have a realtor hat on with nothing to do.
Geez, Nick, you were worried about me.
so
Is it?
I love how that was the most eloquent way of saying, are we going to put real estate agents out of business? Expedia, it put travel agents out of business, it replaced them, and a lot of it was driven by consumer demand and behavior, and we study that so much today at Zillow Group. There's a difference, though, in buying an airline ticket as a commodity one time that's a few $100s as compared to your largest investment. We're a media and technology company that is capturing consumers because they're demanding more information and more transparency. Because real estate data, until 10 years ago, was wrapped up very tightly by real estate professionals because it was part of their value prop on how they generate a commission. Those commissions won't change. We're just looking for them to spend more with us in advertising dollars, but we've really opened the doors to that level of transparency. So very different from Expedia in buying or purchasing a commodity versus providing people data to do research.
Okay. Gary, welcome to our event.
Thank you.
Gary Acosta. Appreciate you being here. You wear dual hats, and so let's cover first the mortgage collaborator.
Sure.
What service do you provide the industry? And your board is filled with
Luminaries.
pretty amazing
Yeah,
people. Yeah.
well.
So this is a serious organization.
Well, I mean, the thrust behind the Mortgage Collaborative is really a couple things. One is helping smaller mortgage banking firms compete with some of the bigger guys.
Okay.
And if you think about it in other industries, you think about, say, how Home Depot put a lot of mom and pop hardware stores out of business, right? And so most people don't know that Ace Hardware Store is actually a co-op. So it was a bunch of mom and pop hardware stores pooled together and bought their hammers and nails and whatnot as a group, and were able to compete with the bigger guys because they could buy in bulk and they got the benefits of economies of scale. And so the Mortgage Collaborative has a similar sort of strategy, and that is help these smaller mortgage banking firms pool together so that they can buy goods and services at the same price as the Wells Fargos of the world and so forth, and therefore be able to compete on price. That's kind of the beginning premise. The other part is more educational, masterminding, sharing best practices. We have sort of observed, and I think maybe some of it has been stimulated by stuff like what we're doing, market share, really shift from the big guys down to the smaller players. And we think that's good for the marketplace because it gives consumers more choice.
Okay. You just had your big event. What were some of the main takeaways for the people that attended?
The collaborative?
Yeah.
Yeah, so we had a conference this summer in Denver, and some of the things that are affecting mortgage bankers in general are the changes in the regulatory environment out there. There's a lot happening with the CFPB. It's a big judgment that went down that may sort of curtail that a little bit. But certainly one of the issues that is talked about a lot is how to deal with the regulatory issues, which are really increasing costs substantially. Secondly, is changing demographics. So the marketplace is changing. The consumer is changing. The needs of those consumers are changing quite a bit. How do we qualify buyers that are coming from different backgrounds, that have different experiences, use credit differently, earn income differently? How do we get more of them into the credit box? How do we convert many of them to become homeowners down the line?
Okay. Sean, in the investor space, who do you see succeeding? What are they doing differently or better than other people are?
Well, what's interesting is, both for investors and realtors, it's kind of the old school stuff is working the best, right? So as large players come in and dominate online, it's getting back out there and knocking on doors and doing direct mail and a lot of those things that are really, helping a lot of folks close deals, unless you want to buy leads online. So on the investor side, it really hasn't changed that much, at least not yet. There are interesting things, I think, out there on the horizon for investors with companies like Open Door, who are starting maybe to provide a challenge in the way that other companies have been a challenge in other industries.
I'm just curious, how many of you have heard what Open Door? Okay, just a few. So just briefly tell. I went to their website.
Open Door is just the old, flipper model, right? You buy the house, and make the person a cash offer, and then you resell and flip the house. But what they do is they have a nice, pretty website where you go to say you want to sell your house, and they probably have a little bit tighter margins than the traditional investor margins. They clean the house up, and then they have a nice little app. They're only in a couple of markets so far, Phoenix and I think Dallas. And they have a nice little app, and people, and this is a piece that I think's been doing okay for them, people can go do an open house anytime between 6 a.m. and 9 p.m. with no agent. So they literally walk up with their phone and the door unlocks for them, and they go in and tour the house. And so they've kind of just taken the whole flipping thing to the next level. They've raised $100 million in capital for their business operations, not for the funds for flipping the house.
Right. Now, you also talked about, there was some other names you and I talked about. It's in more the real estate space, the Compass, or the, what do you call it, Really?
Yeah, you've had, just in the first half of this year, you had $1.8 billion of big money kind of come into the real estate tech space. Now, a lot of that money went into, folks that want to be Zillow overseas. But companies like Compass, who wants to change, kind of the brokerage model a little bit, they also have one of these, open house type apps and some other things. They talk a lot about, giving their agents benefits through big data analysis and things along those lines. Another upstart in the Bay Area right now that's trying to change the brokerage model is Reali. I don't know, Reali. And, so there's definitely a lot of money pouring in trying to disrupt real estate right now.
Okay.
And so, it's almost like everybody's so worried about Zillow way back when, but, there's a lot more happening right now, I think.
The way you described it, again, I shared this with you. Sean's much more tech-versed than I am. He shared that you really were a big service to an agent that had a listing, that if they were in the listing business, that your listing goes there for free, and it's really, you're not trying to be a competitor with them. You're trying to be a kind of a partner and drive interest, and they could receive the leads as a buyer interest, or another agent could.
The Norris Group would like to thank its gold sponsors for supporting I Survived Real Estate, Auction.com, Coachella Valley Real Estate Investors Association, Coldwell Banker Town & Country, Elite Auctions, In a Day Development, Inland Valley Association of Realtors, Jennifer Buys Houses, Keller Williams Corona, Keystone CPA, Las Brisas Escrow, LA Green Designs, LA South RIA, New Western, North San Diego Real Estate Investors, Northern California Real Estate Investors Association, Orange County Investment Club, Orange County Building Industry Association, Pacific Premier Bank, Pasadena Phoebe, Pilot Limousine, Real Wealth Network, Realty 411 Magazine, Realty Executives Inland Empire, Rick and Leanne Rossiter, Sunoco Corporation, South Orange County Real Estate Club, Spinnaker Loans, U-Direct IRA Services, Weston South Coast Plaza, Chase Photography, Wholesale Capital Corporation, Wilson Investment Properties, Inc.
For more information on hard money loans and upcoming events with the Norris Group, check out thenorrisgroup.com. For information on passive investing with trust deeds, visit tngtrustdeeds.com.